Matt, I've been talking to a number of founders, public and private, in the sort of low-code, no-code space about how key that is strategically at a time when IT talent is hard to find. So what are you investing in now, and why do you say that's so important?
Yeah, well, low-code is going to weather a potential recession better because it allows our customers to adapt to circumstance, to pivot quickly, to be agile. And so we expect strength, and we also have strength because we have a 99% gross renewal rate. So you figure 99 cents out of every dollar renews on an annual basis. So coming into a potential recession with these strengths on our side, I see it as an opportunity for growth, and we're proceeding accordingly with an aggressive hiring plan. We're actually hiring faster than we had been prior to the downturn. And I think it's an opportunity for picking up great talent.
Well, why are you hiring faster? Is it because the supply of talent is better? And I mean, even public companies need to worry about cash burn rates. What's your calculation there?
The supply is slightly better. Now's the time that you can get a great resource you might not be able to in other circumstances. Also, we're opening major new offices in India and Mexico. And so the ramp up for those offices contributes to the increase in hiring.
Hey, Matt, thanks for joining us. I understand the opportunity to be offensive, find opportunity in this market, but do you have to be profitable to do so? You guys went public back in 2017. You're still losing money. Is that opportunity afforded to companies that have already gotten their balance sheets in order?
Look, I think it's possible. Depending on your circumstance, you can always do this. We have capital available, and we're very prudent always. We're a bootstrap, actually. We went all the way to the IPO with just $10 million of external capital. So we know what it means to earn the money before we spend it. And we're very careful with the expenditures we make, which contributes to our unusually good margins as well. So we're careful, but we're also seeing this opportunity for what it is, which is a chance to break forward in a competitive and valuable industry. And we're going to play accordingly.
Right, but the market sentiment has shifted over the last few years. Investors have been more patient. They've typically wanted to see growth, but we're in a moment where investors, I'm sure many of yours as well, want that path to profitability. Your opportunity in the moment, if you are looking at M&A activity or investing back in the business, what does that do to your profitability timeline?
You're entirely right, and Appian takes a long view. And so what I'm looking for is many years out, not what's fashionable this quarter, but many years out. And we're playing it correctly for the long-term view. Also, profitability is always within our reach. We could choose within a quarter or two. I'm intentionally making a few investments, but we never let it get out of sight.
Okay, then when are you telling investors you can be profitable? Have you given them that timeline?
We have not, though we could be profitable at any time should circumstances dictate. We will naturally glide toward it, but we haven't committed to a date.
Tell me about your communication with employees at this point about the promise of the company. Sometimes there's a tension between the long view and the long-term value that you want to build, the vision that you have with employees, and then, especially during a time like this, the shorter-term profits, or at least indication that you can show profits that investors want to see. What is that vision about the advantage that you hope to seize and prove out, say, in the next 3 years?
Employees can see it happening. They know that in the first half of this year, we had the highest revenue growth rate that we've had since our IPO, 31% in revenue growth in the first half of this year. So they see that momentum building, and they're confident that the investments make sense.